Mastering the 4H time frame with ICT concepts and daily bias. Introduction: The biological trap of fast trading. Most traders believe that faster trading equals more profits. The 5-minute chart promises action, excitement, and the illusion of control. But what if this approach is sabotaging your success? The truth is, short-term trading on lower time frames like the 5-minute chart creates what neuroscientists call a biological trap. When you're glued to rapid price movements, your amygdala, the brain's emotional center, lights up like a Christmas tree. Cortisol floods your system. Your prefrontal cortex, responsible for rational decision-making, shuts down. You're no longer analyzing the market, you're reacting to hormones. This is where the Sigma Edge philosophy diverges from retail trading. We don't chase candles, we don't react to noise. We build positions based on structure, patience, and smart money principles. The 4-hour time frame combined with ICT, inner circle trader, concepts, and daily bias analysis creates a systematic approach that removes emotion and amplifies profitability. This ebook will show you why boring trading is profitable trading and how to implement the Sigma Edge system for consistent results. Chapter 1. Why lower time frames destroy accounts. The neuroscience of trading failure. When Marcus started trading, he was like most beginners, addicted to the 5-minute chart. He believed more trades meant more opportunities. After 6 months, his 15-minute chart strategy showed a 72% win rate, yet he was barely breaking even. The problem wasn't his strategy, it was his time frame. The biological response to lower time frames. Amygdala activation. Rapid price movements trigger fear and greed responses within seconds. Cortisol spikes. Stress hormone floods your system, clouding judgment. Prefrontal cortex shutdown. The rational brain loses control to emotional impulses. You're no longer analyzing the market, you're reacting to hormones. Noise versus structure. The 80-20 rule. Here's the mathematical reality that most traders ignore. 5-minute chart composition. Mostly noise with minimal structure. Random fluctuations dominate. Difficult to identify true institutional movements. 4-hour chart composition. Clear structural patterns. Institutional footprints visible. Reduced market noise. When you trade lower time frames, you're essentially building your entire career on market noise, random fluctuations, liquidity hunts that have nothing to do with the true direction of institutional money. The 4-hour chart filters out this noise. It reveals the real story, where smart money is positioning, where liquidity is being engineered, and where the true momentum lies. Marcus's transformation. After switching to the 4-hour chart, Marcus's results changed dramatically. On the 15-minute chart, high win rate but barely breaking even. Small winners eaten by occasional large losses, constant stress and decision fatigue. On the 4-hour chart, lower win rate but consistently profitable. Larger winning trades with controlled losses. The average winner was 3 to 5 times larger than the average loser. Notice the paradox. A lower win rate produced higher profits. Why? Because the 4-hour chart allowed Marcus to capture meaningful moves with proper risk-reward ratios. Quality over quantity, structure over noise, patience over impulse. This is the Sigma Edge. Chapter 2. The 4-hour time frame advantage. Why 4H is the sweet spot. The 4-hour time frame sits at the intersection of swing trading and position trading. It's fast enough to capture meaningful moves within days, yet slow enough to filter out the noise that destroys retail traders. Benefits of 4H trading. Rational decision-making. You have hours to analyze setups, not seconds. Clear market structure. Trends, ranges, and institutional patterns are visible. Reduced stress. Check charts twice daily instead of every 10 minutes. Higher risk-reward. Capture significant moves with controlled stop losses. Capital preservation. Fewer trades mean fewer opportunities to lose money. ICT concepts on the 4-hour chart. The Inner Circle Trader methodology, developed by Michael J. Huddleston, focuses on understanding institutional order flow. When applied to the 4-hour time frame, ICT concepts become even more powerful. Key ICT elements for 4H analysis. Order blocks. Institutional accumulation or distribution zones where banks and hedge funds place massive orders. On the 4H chart, order blocks represent significant areas where smart money entered positions. Fair value gaps, or FVG. Imbalances in price where one candle closes and the next opens with a gap, leaving unfilled orders. These act as magnets for price retracement. Liquidity pools, areas where stop losses cluster, above equal highs or buy-side liquidity, or below equal lows, sell-side liquidity. Institutions hunt this liquidity before reversing. Market structure shifts. Break of structure, or BOS, confirms trend continuation. Change of character, or CHOCH, signals potential reversals. On 4H, these signals are significantly more reliable. Premium and discount zones. Price trades at a premium above 50% of the dealing range or at a discount below 50%. Smart money buys at discount and sells at premium. Time frame alignment, the Sigma Edge approach. The Sigma Edge system uses a top-down analysis combining multiple timeframes. Multi-timeframe analysis framework. Daily. Establish directional bias and identify major liquidity zones. 4-hour. Refine entry zones, confirm structure shifts, identify order blocks. 1-hour. Fine-tune entries within 4H order blocks for precision. The golden rule. Never trade against the daily bias on the 4-hour chart. When daily structure aligns with 4H setups, you have institutional confirmation of backing your trade. Chapter 3. Daily Bias, Your Trading Compass. What is daily bias? Daily bias is your directional roadmap for the trading session. It answers the fundamental question, who is in control, buyers or sellers? Without daily bias, you're trading blind. You might catch moves, but you'll also get chopped up in consolidation or trade against the institutional flow. Daily bias determination process. Identify daily market structure. Are we making higher highs and lower lows, bullish, or lower highs and lower lows, bearish? Mark key liquidity levels. Where are equal highs and equal lows that institutions might target? Locate unmitigated order blocks. Which supply or demand zones haven't been tested? Assess premium versus discount. Is price in an optimal buying zone, discount, or selling zone, premium? Determine session expectation. Based on structure, where is price most likely to go? Bullish daily bias framework. When to adopt bullish bias. When price is making higher highs and lower lows on the daily chart, current price is trading at or below the equilibrium of the daily dealing range, discount. Unmitigated demand zones exist below current price. Recent CHOCH or BOS to the upside confirms shift in momentum. Trading strategy with bullish bias. Once bullish bias is established, drop to the 4-hour chart and look for pullbacks into 4H demand zones or order blocks, fair value gaps that price can fill before continuation, sell-side liquidity sweeps below obvious lows before reversal, confirmation through 1H BOS after 4H structure holds. Target areas, previous daily highs, buy-side liquidity above equal highs, premium zones, 62 to 79% of the dealing range. Sarah's respect-based transformation. Sarah tracked 87 setups on the 15-minute chart that she didn't take because she decided to test the respect approach first.
Results of hypothetical 15-minute entries. Most would have hit stop loss. Only a small portion would have been profitable. Average loss would have exceeded average wins. Results after switching to 4H respect method. Significant improvement in trade quality. Strong win rate with excellent risk-reward. Fewer trades, but much higher profitability. Consistent positive performance over time. Sarah went from barely surviving to consistently profitable, not by finding better setups, but by waiting for confirmation. The patience paradox. Fewer trades equals more money. The market rewards accuracy, not activity. Chapter 5. Building Your Sigma Edge Daily Routine. The Anti-Overtrading System. Overtrading is the #1 account killer. The 4-hour time frame naturally prevents this, but only if you have the discipline to honor it. The Sigma Edge Daily Routine. Morning session. Review daily chart. Confirm or update daily bias. Mark key liquidity levels, equal highs or lows. Identify unmitigated order blocks on daily and 4H. Note premium-discount zones. Set alerts for 4H order block touches. Evening session. Review 4H chart. Check for order block interactions. Look for respect confirmation, minimum 2 4H candles. If setup valid, prepare entry for next session. Document analysis in trading journal. Set alerts for structure breaks or invalidation. Intraday. Do nothing. Live your life. The market will wait. Practical implementation steps. Step 1. Delete trading apps from phone. If you can check your trades every 10 minutes, you will. Remove the temptation entirely. Step 2. Set conditional alerts. Use TradingView or your platform to create alerts. Price entering 4H order block. BOS or COCH on 4H chart. 4H candle close above or below key level. Step 3. Lock your terminal. Some brokers allow you to set trading hours. Lock your account outside of your 2 daily review sessions. Step 4. Journal every setup. Document the following for each potential trade: daily bias direction, 4H order block location, liquidity targets, entry criteria, risk-reward calculation, actual outcome. Step 5. Review weekly performance. Every Sunday, analyze how many setups appeared, how many you took, overall trading performance, mistakes made, such as impulsive entries, ignoring daily bias, etc., lessons learned. Chapter 6. The Psychology of Sigma Edge Trading. Identity over behavior. Most traders say, "I'll try trading 4H." This language reveals a lack of commitment. It's an experiment, not a transformation. The identity shift. Don't say, "I'm going to try 4H trading." Say, "I am a 4H trader." This isn't just semantics. Your identity drives your behavior. When you identify as a 4H trader, you don't resist the urge to check lower time frames. You simply don't consider it. The boring path to wealth. There's a harsh truth about profitable trading. It's boring. What boring trading looks like: checking charts twice a day, waiting hours for confirmation, taking a few trades per week instead of per day, having nothing to do most of the time, watching Netflix while your trades run. If you need excitement, trading is not for you. Go skydiving, play poker, but don't confuse entertainment with wealth building. The Sigma Edge Principle. The more boring your trading feels, the more money you're probably making. Managing the need for action. The urge to trade is withdrawal from dopamine. Your brain craves the hit it gets from entering positions. Strategies to combat overtrading urges. Backtest during urges. If you feel the need to trade, open your backtesting platform and practice on historical data instead. Physical exercise. Replace trading dopamine with endorphin release from running, lifting, or martial arts. Content creation. Channel trading knowledge into educational content, videos, posts, or coaching. Study ICT material. Spend time learning deeper concepts rather than forcing trades. The Sigma Edge trader understands that capital preservation is the foundation of growth. You can't compound profits if you keep giving them back to the market through impulsive trades.
Bearish Daily Bias Framework. When to adopt bearish bias? Price is making lower highs and lower lows on the daily chart. Current price is trading at or above the equilibrium of the daily dealing range, premium. Unmitigated supply zones exist above current price. Recent CHOCH or BOS to the downside confirms shift in momentum. Trading strategy with bearish bias. Once bearish bias is established, drop to the 4-hour chart and look for pullbacks into 4H supply zones or order blocks, fair value gaps that need to be filled before continuation lower, buy-side liquidity sweeps above obvious highs before reversal, confirmation through 1H BOS after 4H structure holds. Target areas. Previous daily lows, sell-side liquidity below equal lows, discount zones, 21 to 38% of the dealing range. The 4H momentum confirmation. Daily bias sets the direction, but 4-hour momentum confirms execution timing. 4H momentum characteristics. Strong momentum candles. Large-bodied 4H candles with minimal wicks indicate institutional participation. Sequential candle closes. 3 consecutive 4H closes in bias direction confirm sustained momentum. Volume expansion. Significant moves accompanied by increased activity. Fair value gaps formation. Momentum candles create fair value gaps, signaling imbalance. The Sigma Edge rule. Only take trades when 4H momentum aligns with daily bias. This confluence significantly reduces false signals. Chapter 4. Touch versus Respect, the Professional's Edge. How amateurs enter trades. Amateur traders see a support or resistance level and immediately enter when price touches it. They believe the level will hold simply because it exists on the chart. This approach fails most of the time based on live trade tracking data. Why touch entries fail? No confirmation that institutions are defending the level. Price often wicks through levels before reversing, stop hunting. Liquidity sweeps trigger retail stops before the real move begins. Emotional entry based on fear of missing out. How professionals respect levels. Professional traders don't enter on touch, they wait for respect, price behavior that confirms the level is being defended by institutional orders. The respect confirmation checklist. Price reaches order block or fair value gap. Institutional zone is contacted. Wait for 4H candle close. Let the first 4H candle close at or near the level. Observe the second 4H candle. Confirmation comes when the second candle shows rejection, long wick in bearish zones, long lower wick in bullish zones. Minimum wait time, 2 4H candles equals confirmation time. Entry on the third candle only if structure holds. This process gives your prefrontal cortex 8+ hours to analyze the setup rationally. No amygdala hijacking, no cortisol-fueled gambling.
Chapter 7. Advanced ICT Integration on 4H. Order Block Refinement. Not all order blocks are created equal. On the 4H chart, we prioritize order blocks with institutional characteristics. High probability 4H order block criteria. Formed after BOS or CHOCH, structure confirmation increases validity. Located in discount, demand, or premium, supply. Optimal zones for institutional positioning. Contains FVG. Imbalance within the order block adds confluence. Unmitigated. Price hasn't returned to test it since formation. Volume expansion. Formed during high activity period. Order block entry strategy. Wait for price to enter the order block zone. First 4H candle enters zone, observation. Second 4H candle shows rejection wick, confirmation. Third 4H candle breaks in bias direction, entry trigger. Stop loss beyond order block with proper buffer. Target next liquidity with strong risk-reward minimum. Advanced tip. FVGs within order blocks create sweet spots with double confluence. These setups have exceptional win rates when aligned with daily bias. Fair value gap trading on 4H. Fair value gaps are among the most reliable ICT concepts for 4H trading. They represent inefficiencies where institutions will look to rebalance price. FVG formation rules. An FVG exists when a candle 1 closes, candle 2 creates the gap, large momentum candle, candle 3 opens away from candle 1, leaving a gap. Bullish FVG. Gap below current price where price can retrace before continuing up. Bearish FVG. Gap above current price where price can retrace before continuing down. The Sigma Edge FVG strategy. Identify FVG formation on 4H chart. Confirm FVG aligns with daily bias direction. Wait for price to retrace into the FVG zone. Look for 4H candle rejection from FVG zone. Enter on next 4H candle in bias direction. Stop loss beyond FVG with proper buffer. Target next liquidity with strong risk-reward minimum. Advanced tip. FVGs within order blocks create sweet spots with double confluence. These setups have exceptional win rates when aligned with daily bias. Liquidity engineering. Institutional traders don't enter randomly. They engineer liquidity by 1. Pushing price toward obvious stop clusters like equal highs or lows. 2. Triggering retail stops to fill their large orders. 3. Reversing in the intended direction. Reading liquidity on 4H. Buy-side liquidity. Stop losses above equal highs, psychological round numbers 1.100, 1.200, or swing highs. Institutions sweep these before dropping price. Sell-side liquidity. Stop losses below equal lows, psychological round numbers, or swing lows. Institutions sweep these before rallying price. The Sigma Edge liquidity play. Identify liquidity pool opposite to daily bias. Wait for 4H candles to approach liquidity. Observe sweep and immediate reversal, wick rejection. Enter on next 4H candle in bias direction after sweep. Stop loss with proper buffer beyond sweep point. Target next opposing liquidity or major order block. Example, daily bias is bearish. Price rallies into buy-side liquidity above equal highs. 4H candle wicks above highs and closes below, liquidity grab. Next 4H candle drops, entry signal confirmed. Kill zones and session timing. While 4H trading is less session dependent, awareness of ICT kill zones enhances edge. Primary kill zones, New York time, London open, high volatility, initial liquidity sweeps, New York AM, maximum institutional activity, major moves, New York PM, consolidation or continuation. 4H application. Entries during or just before kill zones have higher probability of immediate follow-through. Avoid entries during Asian session, low volatility, prone to false breaks.
Chapter 8. The Sigma Edge Trade Management System. Position sizing for 4H trading. Proper position sizing is what separates consistent winners from boom-bust traders. The 1 to 2% rule. Never risk more than 1 to 2% of your account on a single trade. With 4H trading's wider stops, 30 to 50 pips typical, this becomes critical. Position size calculation. Position size equals risk amount divided by stop loss in pips multiplied by pip value. Example. Account size with proper risk management equals controlled position sizing. Always calculate position size based on your specific stop-loss distance and account capital. Take profit strategies. Partial profit taking. First target, close half of position, move stop to break even. Second target, Close additional portion, trail stop to previous target. Runner. Let remaining portion run to major liquidity or structure. Structure-based exits. Don't use arbitrary pip targets. Exit at next unmitigated order block, major liquidity pools, premium/discount zone extremes, 97% or 21% of range, Chach signals indicating potential reversal, stop-loss management, initial stop placement. For demand zones, long trades, place stops below order block or FVG with proper buffer. For supply zones, short trades, place stops above order block or FVG with proper buffer. Stop adjustment rules. Move to break even after the first 4H candle closes in profit. Trail stop to most recent 4H swing low, longs, or swing high, shorts, after targets achieved. Never widen stops. If analysis was wrong, accept the loss. The Sigma Edge philosophy. Protecting capital is more important than catching every pip of a move. A preserved account can always trade again. A blown account cannot. Chapter 9. Common pitfalls and how to avoid them. Mistake number 1. Trading against daily bias. The problem. Taking a bullish 4H setup when daily bias is bearish or vice versa. The solution. Never trade counter to daily structure. If daily is bearish, only take 4H short setups. Wait for daily structure to shift before reversing bias. Mistake number 2. Impatient entries. The problem. Entering on the first touch of an order block without waiting for respect confirmation. The solution. Implement the 2-candle rule. Wait 8 hours minimum. If the setup is valid, it will still be there. Mistake number 3. Ignoring liquidity context. The problem. Taking trades without considering where nearby liquidity pools exist. The solution. Always ask, where are stops clustered? Avoid longs just below major sell-side liquidity. Avoid shorts just above major buy-side liquidity. Mistake number 4. Checking charts every hour. The problem. Constantly monitoring 4H trades defeats the entire purpose of the time frame. The solution. Set alerts and check twice daily only. Trust your analysis. Micromanaging trades leads to premature exits and emotional decisions. Mistake number 5. Overcomplicating analysis. The problem. Adding dozens of indicators, drawing hundreds of lines, paralysis by analysis. The solution. Keep it simple. Daily bias plus 4H structure plus order blocks plus FVG plus liquidity. That's it. More complexity doesn't equal better results. Mistake number 6. Revenge trading after losses. The problem. Taking impulsive trades to make back losses immediately. The solution. Accept that losses are part of trading. Journal the loss, identify what went wrong, and wait for the next valid setup. Skip the next setup if you're emotional. Mistake number 7. Abandoning the system after losing streak. The problem. Experiencing 3 or 4 losses in a row and questioning the entire approach. The solution. Even a 65% win rate system will have losing streaks. Track 50+ trades before evaluating system performance. Short-term variance is normal. Chapter 10. The Sigma Edge Mindset. Redefining success. Most traders define success by daily P&L. This creates emotional instability and poor decision-making. The Sigma Edge success metrics. Process adherence. Did I follow my rules? Patience level. Did I wait for confirmation? Risk management. Did I respect my risk management rules? Journal completion. Did I document the trade? Emotional control. Did I trade with calm rationality? When you control the process, profits become a natural byproduct. The 1,000 trade perspective.
You're not trading for this week. You're building an edge over 1,000 trades. Mental framework. Early trades, learning phase, focusing on rule adherence. Mid-stage trades, refinement phase, optimizing entries and exits. Advanced trades, mastery phase, consistent execution with minimal emotion. 1 bad trade means nothing. 10 bad trades mean little. But 1,000 trades following the Sigma Edge system, that's where life-changing wealth is built. Embracing the Sigma lifestyle. The Sigma Edge isn't just a trading strategy, it's a lifestyle philosophy. Core principles. Independence. You don't follow the herd, you analyze and decide for yourself. Discipline. You commit to systems and honor them even when emotions resist. Patience. You understand that wealth is built slowly, one quality trade at a time. Rationality. You make decisions based on data and structure, not hope or fear. Continuous improvement. You study, backtest, and refine endlessly. The market doesn't reward the smartest traders, it rewards the most disciplined ones.